Good morning, everybody. It's Doc here from OnTheMoneyOptions.com, and it is Monday, March 26th. And with all the volatility in the market, I thought I'd do a little video on how you might have an all bond portfolio, or how you might manage a portion of your portfolio using the 20-year Treasury ETF called TLT. Before we get started with the trade, there's a myth that I want to dispel with here. That myth is that bonds are negatively correlated to stocks. There's a very common misconception about that. On the long term, bonds and stocks are very much correlated together tightly. So here is a chart that will prove this point. This is the S&P 500 and the TLT from 2003 until the present time. 2002 is when the TLT ETF started. You can see that the S&P 500 is the blue line and the red line is TLT. And one of the things that I want to point out to you here is that over a long period of time, you see they've both moved up to the right over this 15-year period of time. So they are correlated together. That's further evidenced by this line down here that shows the correlation between the TLT and the S&P 500 being in the positive territory for most of the time. Now there's a short period of time here that I want to discuss. That's the Great Recession, it was called, 2009-2010. You can see here in three instances, and I have highlighted those cases here on the chart, that when the TLT moves up and crosses the S&P 500, this is typically during a period of time that the S&P 500 is making a sharp downturn. So we can use this information to develop a trading strategy that gives us an opportunity to participate in the market, using a bond portfolio and keeping this correlation in mind. So let's take a look at the trade. We are going to assume that you're using a qualified account like an IRA, so there are no tax consequences to buying and selling, and that the account is set up to trade stock options. Well, we use what is called a covered call strategy using stock and stock options. To implement the covered call strategy, you first purchase the stock at the current price. After that, you will sell a covered call that is above the current price of the stock. Since you own the stock on which you sold the call option, the position is considered covered. This is where the term covered call is derived. When you sell a call, you are selling the right for someone to buy your stock at the agreed upon strike price any time during the period or duration of the call option. For this right, you are paid what is called a premium. I want to point out that regardless of what happens to TLT, the premium you are paid, you will keep. So let's set up the trade. First, we'll buy 100 shares of TLT at the current price of $120.11. After that, we will sell a covered call. I'm going to look at a period of time that is roughly 3 months into the future. We will sell a call in the June 2018 series. I will choose a strike price that is above the current price and has approximately a 30% chance of being in the money at expiration. In this example, I will choose the June 2018 $123 call and sell it for $1.15 per share. Now that we've have the trade set up, let's consider the potential outcomes. There are two potential outcomes. The first is that TLT will not go above the $123 strike price and our option expires worthless. We keep the premium and we keep the stock. Remember, in this case, there's only a 30% chance that TLT will be above $123 per share at the June expiration. This probability is approximated by the delta of the option. The second outcome is that TLT will go above the $123 strike price and your stock position will be purchased from you, or as we say, called out, at $123 per share. Let's take a quick look at the return in each outcome. In the first outcome, TLT stays below $123 per share and we keep the premium. We invested $120.11 per share and keep $1.15 per share premium. That is approximately a 9/10% return for the period. TLT pays 2.6% annually, and if you could do this 4 times per year, you could push your annual return to approximately 6%. In the second outcome, the stock is called away at $123 per share. We paid $120.11 and received $1.15 per share premium. This results in a cost of $119.06. So the profit on the second outcome is $123 minus $119.06, or $3.94 per share. This creates a return for the period of 3.3%. If this could be done 4 times a year, that would be a nice annual return. It's impossible to say what the outcome will be, but you see the potential. Here are some of the benefits of this approach. First, we're using an ETF that tracks the 20-year Treasury bond. There is a perception of safety in the U.S. Treasuries. Secondly, we're using our knowledge of the correlation of bonds to stocks to craft the trade. We know that in the very short term, if the U.S. equities markets go down, there will be upward price pressure on the bond ETF. So you could envision a scenario where something drastic happens in the equities markets and your bond trade is called out and you're now sitting in cash. On the other hand, the bond ETF tracks positively with the stock market over a longer period of time. And this creates the opportunity for you to benefit from that knowledge. So from this example, you can see that it's possible to craft a trade using the 20-year U.S. Treasury ETF TLT. So until next time, this is Doc saying so long and stay hedged.